And so one of the things that I'm cautious about going into next year is I don't think there's a lot of room for multiples to rise higher than here. I think they can hold, but this is not middle of 22. I like to find DHQs, dislocated high quality companies. I just don't think they rise from here in the way that they have the last 2 years. We've had a 2-year bull market because we started off with very low multiples. That is not the situation now. Every single one of the highest quality names I've covered, all of them have had sell-offs of between 20 and 40%. The thing to try to do is when I look at investments, I try to minimize 2 risks: fundamental risk and valuation risk. And so I wait for that 20% correction to buy the high quality companies or to add to positions. I work with Evercore ISI. I've been working on Wall Street for coming on 30 years now. So I'm the oldest and longest lasting internet analyst in the US, I guess in the world. I started the first Friday I worked in my job, I got a call from eBay that was looking to go public. And so I've been involved or watched almost every major internet stock since 1998. It's a job I've really enjoyed. I'm based in San Francisco, and I have a small team that works with me, 6 of us, who spend all of our time keeping track of about 40 internet stocks. Never with all tech stocks. Like most sectors, there's usually a handful of names that gain most of the market cap attention and gains. But there are 2 or 3 underlying positive drivers for the highest quality internet stocks. First is economic growth, which globally seems to be relatively resilient. We are going through a soft landing, or maybe even no landing. So the economic environment has stayed, reasonably strong. Second is interest rates are moderating. Usually that's a beneficial backdrop for stocks, particularly for tech stocks that are long duration. And then third, there is specifically for the technology stocks, there is a major technology trend. It's artificial intelligence. And there are more and more examples of how artificial intelligence is being used by these companies to improve their products, improve processes, to create cost efficiencies, to create better stronger business models. I think all 3 of these trends continue into 2025. Barring an external shock, we expect GDP growth to remain, reasonably robust. We think interest rates will continue to slowly moderate, and we think we have the greatest confidence that the benefits of AI will become more and more apparent in these business models, in their financial results. That should be a good backdrop for tech stocks. I think there are more examples of where AI is creating financial value. Let me give you 3 examples. At Google, 25% of the code written at Google is written by AI, and then the human engineers review that. That's a cost efficiency. Amazon at AWS will tell you that their cloud services, their AI cloud services are growing just as fast or faster than cloud revenue grew 15 years ago. I.e., that's revenue to Amazon. The AI services cloud revenue is growing at triple-digit rates to 100% plus year over year. And then also at Amazon, there's an example. It's not AI so much, but it's robotics, although that's tied into AI. Deploying robotics in their distribution centers is allowing them to reduce their cost to serve, the amount of time, the total all-in cost of getting a product to you by 25%. So we're finding more of these examples of companies effectively deploying machine learning, AI, and robotics to generate new revenue streams or to reduce costs. So I think there are good examples. Even though there's a lot of volatility, I find that tech stocks largely follow fundamentals. So if the revenue grows at a premium rate, 20% plus, and profits grow at a robust growth rate, over time the stocks go higher. I look at stocks that I've covered for almost 30 years. There's Amazon and there's eBay as one example. Amazon has it's been an enormously successful stock, but it's also been an enormously successful fundamental company with revenues that are multiples and multiples higher than where they were 10 years ago. They were able to sustain 20% revenue growth for 10 years after hitting 25 billion in sales. Only two other companies in history have done that, Apple and Google. So I found that the stocks have followed the fundamentals. eBay is a company that essentially didn't grow for almost a decade, and its stock has been stagnant for almost a decade. So I do think that there's volatility around the stocks, but I have found that rarely do stocks and fundamentals diverge for more than 6 or 9 months. You can have plenty of shocks to the market. In the beginning of 22, tech stocks were terrible because of this aggressive rise in interest rates. In the beginning of 2020, tech stocks and all stocks were terrible because of COVID. So these shocks do happen, and I'm sure will happen again. But as the fundamentals of the highest quality names, pretty much the Magnificent Seven, those fundamentals are dramatically stronger now than they were 4 years ago, 5 years ago, and the stocks are higher. I generally find if you can find the high quality companies, the stocks usually follow. Because even with tech stocks, I find that stocks have followed fundamentals. So I think that basic rule of the market holds in pretty much any sector. Now, the market may put different multiples on those fundamentals. And with tech stocks, usually people think growth stocks. And I think the market is willing to pay more for growth stocks for very simple reasons. A dollar in earnings that grows 20% each year for 5 years is worth more than a dollar in earnings that is likely to grow 5% for 5 years. Now, those forecasts may be wrong, and that's what causes the volatility, but people will pay more for that because it's so rare you find companies that can do that. So that's why I focus so much in my book, and when I look at the stocks I covered today, if I can find companies that are growing at a premium growth rate, 20%, 15%, they must be doing something unusual because GDP growth worldwide is 3%, 4%. So if companies can really grow 5 times faster than the global economy, there's usually better products, more they're attacking bigger markets. They're very good management teams. So yeah, that's the answer, right? Even with tech stocks, fundamentals follow stocks follow fundamentals. We'll have to talk about valuation risk, but I have found that even in one of the most volatile sectors out there for the last 25 years, if I had known 25 years ago where their fundamentals would be today, I think I would have largely been able to guess where the stocks would be. Even with tech stocks, stocks follow fundamentals. Well, the market is at a higher than normal PE. The forward multiple for the S&P 500 is 22 or 23 times earnings, so it's high relative to historical standards. It can stay high if GDP growth remains robust, if interest rates continue to moderate, and there aren't any external shocks, and then maybe if AI as a whole can help find more efficiencies in the market. But with generally growth stocks, if they generate faster than typical earnings, they will trade at a higher multiple because markets will pay for scarcity value because there's limited supply and more demand. But it does create risk. And so one of the things that I'm cautious about going into next year is I don't think there's a lot of room for multiples to rise higher than here. I think they can hold, but this is not middle of 22. This is not the beginning of 23 when multiples were very low and you had a real opportunity for outperformance in the market. So I like to find DHQs, dislocated high quality companies. I can identify a lot of high quality companies, but very few of the high quality companies I can identify are dislocated, are on sale. I really like Netflix, but it's not on sale. I really like Meta, Amazon, but they're not on sale. So so hopefully that's a little bit of, I do worry about valuations. They do require, in order to sustain where they are, they need good GDP growth, interest rates to come down, AI innovations to continue. So that does create risk here. And so, but I think that the multiples are sustainable. I just don't think they rise from here in the way that they have the last 2 years. We've had a 2-year bull market because we started off with very low multiples. That is not the situation now. I have no reason to think there's going to be a dramatic drop, but every single one of the highest quality names I've covered has traded off in the last 5 years. All of them have had sell-offs of between 20 and 40%. And some of the highest quality stocks I cover, like Meta and Netflix, have had 75% fall-offs. So I just think you have to get used to it. The market can have a 20% fall-off, and tech stocks can sell off more than that. The thing to try to do is, when I look at investments, I try to minimize 2 risks: fundamental risk and valuation risk. And I try to minimize fundamental risk by only buying high quality companies with good management teams, large market opportunities, good track records with product innovation. And I try to minimize valuation risk by trying to be tactical and waiting to all I can predict is that almost all of these stocks is going to have a 20% correction sometime in the next 2 to 3 years. That's the probable outcome. And so I wait for that 20% correction to buy the high quality companies or to add to positions. Well, you have to answer for yourself the question of why the stock is correcting. So sometimes it's due to a market shock, like interest rates rising at the beginning of 2022. We had a 40% plus correction in tech stocks, but that was because of interest rate environment. Sometimes it's because of very specific things that the company makes a mistake on. Meta had a 70% correction in its stock when growth slowed down and the company didn't seem to be serious about managing costs. Netflix had a 70% correction when growth slowed down and it didn't look like the company had a new growth engine ahead of it. And I actually downgraded the stock then because I wasn't sure what they could do to turn around the growth. And then 3 to 6 months later, they rolled out an advertising plan. And I realized early on that that was a new growth engine for the company. And I became more constructive on the stock. So it depends. You have to ask yourself, why is the stock trading off? And if it's due to a market, or if it's due to more of what I call an expectations correction, that's the correction that you want to buy. So that's where I get back to fundamentals. If revenue growth is consistent or accelerating and margins are expanding or consistent or expanding, that's a strengthening fundamentals story. And you want to be more aggressive in buying the stock corrections on that rather than one where when the stock corrects because the revenue is decelerating sharply and margins are under pressure, that's a fundamentals correction. And you want to be very wary about buying that dip. So it gets back to, this is why I focus on fundamentals so much, because I find that stocks can still be volatile even with better fundamentals, but usually there's a lot of investors who will step in and buy an improving fundamental story. I think for some technology stocks, that makes a lot of sense. A lot of stocks are considered tech, that use tech as their infrastructure, but may not be technology in a way that you and I normally think about technology. So I'll give you an example of Netflix. Netflix is a media company, entertainment subscription company. I consider it a tech stock, but it doesn't really matter. It's been a growth asset. And the way you can decide whether or not it's a good investment is you can do your own research on it and spend $10 a month or $15 a month, depending on the plan, and decide whether you think it's a compelling value to you. Is this something you'd pay more for in the future? So the stocks that have done really well are all ones that I think consumers could understand. Maybe not NVIDIA. That's where you'd really need to understand the marketplace and why companies are spending so much money with NVIDIA. That's a hard thing for a retail investor to understand. But to understand stocks like Netflix, especially here in Korea, I think is relatively straightforward. To understand Amazon, to understand an Airbnb, to understand Meta with Instagram and Facebook, I don't think you need to understand the technology underlying it. You just need to understand you have to decide whether or not you think that they are great deals, whether they are great values, whether they provide a useful service for consumers. Yeah, and I would make the basic point that invest in what you can understand. And if you don't understand semiconductors, you don't have to. You don't have to invest in those. But you can invest in services that you like, that you find, that you enjoy using. Not really. I know I should say that it does, but not really. The market's gone up in the last month because of excitement about President Trump's pro-growth policies. We've been in a bull market since the middle of 2022. I think the market, I think presidential administrations can have an impact on the market, but I think what generally has a much bigger impact on individual companies are their individual fundamentals. I keep saying it, but I believe it. So Amazon will do well under Biden or Trump or any other president if they continue to innovate on their products. If they don't innovate, it doesn't matter who the president is. There are other issues that do come up. So, for tech stocks, it is important that interest rates don't rise. And so you could see how some presidential policies could cause interest rates to rise. That would be a negative for tech stocks. Tariffs are the other issue that companies like Amazon have to be worried about, but also companies like Meta and Google, because 10% of their revenue comes from Chinese-based retailers. So at the margins, presidential decisions that impact interest rates, that impact tariffs, that stifle or enable cross-border trade, they can have an impact on companies. But I think that far and away the biggest driver of companies' fundamentals and therefore of their stock prices is the decisions they make themselves about how well they manage costs, how well they innovate and develop new products, and how well their current products satisfy customers. I think financial markets may react quicker than they did in the past. So maybe that adds to the volatility. But I feel that it's a statement that can be easily tested. I just haven't tested it. You may well have the data to know whether there's greater volatility in the market today than was the case 10, 20 years ago. I mean, we can just look at betas. I just haven't studied it. It feels to me like the markets react more quickly. Fundamental change and technology change, I'm trying to think about whether that's really occurring at a faster pace now than it did before. And I think about the adoption of, well, just in my narrow area, when the internet first came out, the commercial internet first came out in 1997, 1998, 1999, it took many years for companies to really embrace it. There's a lot of skepticism. Smartphones, the adoption was faster. And I think with Gen AI, there's been a very fast adoption amongst corporate companies. So in that case, there's been some faster adoption. But I'll give you one or two examples of technologies that have taken a long time to develop. One is autonomous vehicles. Waymo, a robotaxi Waymo is in San Francisco. I can look out my office window and I can see Waymos. It took 19 years for robotaxis to finally be commercially available. So some of these technologies can be just very, very difficult. I also think about some of the space technologies that we're seeing that I look at less, but some of the companies I look at, like Amazon, are investing in space technology. That also took 10 plus years. So it depends on the technology. I have a yes and no answer to your question. I feel like stocks and the markets react more quickly. I feel like some technology adoption occurs faster, but for true breakthrough new spaces like autonomous vehicles, it could still take, it could still take 20 years. I don't think you're going to have robo-taxis in Seoul. I bet you have them in 5 years. I don't think you'll have them in a year. And the technology's been brewing for 25 years by that point. I think some of the most interesting developments I've seen have been new product launches like the Amazon Kindle, like watching the transformation of Netflix from a DVD business to a streaming business. I really enjoy these Meta Ray-Bans, these eyeglasses that are coming out. Yeah, I've enjoyed watching these companies innovate and come up with new products, and the growth of the cloud business really surprised me. At first, I thought it was I didn't think it would be a great business for Amazon to get into. I was wrong. And that's always some of the most memorable moments for me, the mistakes I made and then what I learned from those. So anyway, those are some of the moments. Well, I think we're going through this amazing example now with Gen AI and what ChatGPT did. To me, there are some wonderful lessons from ChatGPT. It showed you that no company had a monopoly on breakthrough technologies. Google had 90% share, has 90% share of the search market, but the biggest, most interesting innovation in search has come from ChatGPT. I think that's a very healthy sign for the markets, and it's a very good sign for consumers too. We all do better when there are multiple innovative companies. We hope never to be in a situation where only one company is innovative in the space. I find that to be one of the most interesting recent examples of a really a stunning innovation that came from a source that nobody knew about. ChatGPT's only been around for 5 years. And then what I find interesting is that a company like Google was able to adapt that technology. They had been investing in AI for many years, but I think that ChatGPT forced Amazon to accelerate its product development, and I think Google came out with better technology and a better service because of ChatGPT. I think competition has made these companies better, and that's a good thing for us consumers and for enterprises. I don't think, I think maybe only Tesla and Apple. Tesla and Apple are the two of the Mag 7 that have a significant presence in China. Amazon doesn't, Google doesn't, Meta doesn't. Who am I missing? So it's unfortunate for the major tech companies and for most major tech companies that there isn't much of an opportunity for them to succeed in the China, given the size of the China market. And China is a highly competitive technology market. Unfortunately for China, I think they are probably regulating that innovation away. That's a real change. I remember visiting China 10 and 15 years ago and being very impressed by the level of innovation there and the company leadership and Baidu and Alibaba. Unfortunately, I think there are political constraints, and I think they are probably negative for Chinese innovation and probably negative for the Chinese consumer too. But that's just a loose opinion. These other, the antitrust issues, yeah, these are very powerful technology platforms. And of them, the one that probably, I think Google is a monopolist in search. Whether it's acted in a way that's really hurt consumers and stifled innovation, I think is a harder thing to prove. But there's, there has been a trial and Google has been found guilty of antitrust. I think that's a harder case to make against Meta, especially given the rise of TikTok. I think that's a hard thing to make against Amazon because its share of the end markets is so much smaller than Google has had. So yeah, I think the bigger the platforms, governments should be investigating these companies, just given how powerful and how influential they are. I think we all as consumers would hope that what ends up stopping these companies is less government regulation and more competition. I think that's probably healthier for all of us, but occasionally regulation is necessary. Well, let me just end and thank you for inviting me here today. I'll just tell you what my top stock ideas are. And there's one that's, I think it's a very interesting Asian internet company. But in the large cap space, my three favorite ideas here are Uber first, Amazon second, and number three is DoorDash. But that's in the large cap space. My one favorite name in the mid cap space is a company called Grab. It's based in Singapore, and it's the leading mobility and delivery company in Southeast Asia, in Indonesia, Malaysia, the Philippines, Singapore, etc. So to me, it's a business model that I think I understand well, having covered Uber and Lyft and DoorDash. And it's a company that's just turned a corner on profitability. It's now generating positive free cash flow. So yeah, those are some of the stocks that I'm particularly interested in now. Uber, Amazon, DoorDash, and Grab. There's always a balance in the U.S. Just like in Korea, there are two major parties in the U.S., and there's just rarely ever a massive swing in the American political economy. Nobody ever really wins more than 55% of the popular vote. And so for anything to really happen, you need to have the agreement of both parties. So that probably means you're not going to have a dramatic shift in U.S. policy. I don't think it'll be as dramatic as the rhetoric suggests it could be. I personally don't like the approach of threatening major tariffs. I don't think that's good for consumers. I don't think that's good for American consumers, and it has inflationary risks. And my guess is that as the policy goes forwards, that the Democratic Party and the Republican Party, they will moderate some of the excesses of the America First strategy. I may be wrong, but I am struck by the fact that just like in Korea, when you have these two parties that are relatively equal in size, and they have been for a long time, you don't normally get radical changes in policy. I hope we don't see a radical change in policy.